Feroz, coming to you, and Siddharth and I were just discussing this before this wonderful show started, that over the next 5 years, the amount of wealth creation that Indian markets will exhibit will pale into insignificance the previous 10 years that we have seen. How do you see this rally panning out beyond the first 1 or 2 days or the first 1 week? How do you see the markets now from the macro point of view and also over the medium to long term, 3 to 5 years?
Siddharth Sahab, Sakshi. Basically, like you said, Sahel Sahab, this is a moment not just from the next 3-4 days perspective, 5 days. Those are going to be very interesting days. If you reflect back from 1999, those are interesting days. I think three things which will happen, and those were important to happen. One is there was a formation of a paradigm shift between debt investment being moved to equity. So the continuity of the government was very critical for this momentum to continue. See, India has about 800 lakh crores of household savings, out of which 3.2% is in mutual funds, 3.2% is in direct equity by individuals. If only 6.5% of the total household savings is in equity, then you needed that kind of momentum to continue. So that will continue. That's point one. Point two, I personally think the first 3 to 4 days could be about the largest stocks. But I'm now reasonably confident that the broader markets, which is small caps and mid caps, which continue to rally, will further outperform Nifty. That's point two, because India has very little free float in these segments. 2.5 lakh crores is there in small cap funds, and that's very small amount. That's 0.3% of India's household savings. So there is very little free float available of small caps, especially in India. So there is going to be re-rating again upwards. Of course, there may be astronomical valuations in some stocks, but that will continue. That's point two. Point three, I think the capital market infrastructure will get a larger emphasis this 5 years.
Okay.
So these are the three important things which I believe will shape the next 5 years. So I would not be surprised if Nifty delivered 12 to 14%, and the broader market delivered 3 to 4% more over the next 5 years compounded, which means that Nifty could double in 5 years, which I think is a great start point for anybody to invest capital.
So Feroz, now dipping into your expertise, tell us 3 funds. One, the allocation that you will have in those 3 funds between large caps, mid caps and small caps, based on how you expect the market to be over the next 3 years, and what will those 3 equity schemes be? If you could just share the names of those funds. Sakshi and I will ensure that from Monday onwards we will dissect those funds in great detail, but if the names that you can share.
Yes, Shailji, like you rightly pointed out, what happens is direct equity is, for most people who don't do this as a profession, is not needed. When we started analyzing top 100 broking clients of ours, transaction-wise, how many are beating Nifty, how many are beating counterparts of mutual funds, you would be surprised 91% of direct equity investors as well, not just traders, underperform the mutual fund basket which we recommend. Because most people who manage their money, they see the winners. Psychologically, your mind tells you to see winners. And the ones which are down, you're always worried, and you will say that, yeah, aa jayenge upar. So point one, I really propagate mutual funds from a sleep easy, still make 15-17% kind of compounded return. Of course, now you're very curious to know which are my 3 schemes. So I'll probably give you a little offbeat because we are in the process of redesigning our model portfolio every first quarter of a financial year. So quant large cap. See, large caps stocks have found it very, large cap fund managers have found it very difficult to beat Nifty, except Sandeep Tandon. Sandeep Tandon is running he was a treasury guy who's the CIO and also the promoter or the founder of Quant. He is a very treasury mindset guy. He has only 17-18 stocks in the large cap category, also uses derivative to hedge his positions. In the last 1 year has changed, out of his 17 stocks, has changed 14 stocks. So he's very dynamic because he uses derivatives in terms of understanding what its spillover on cash market. He's able to use liquid counters much better with his agility. So I would say he beat Nifty last year by 20% in a large cap fund. I think that will continue. So quant large cap would be a reasonable proportion. In the mid cap category, again, little counterintuitive it may sound, Kotak Emerging Equities Fund. Pankaj Tibrewal left that fund. It underperformed its own benchmark by about 19% last year, but that's a very clear case of mean reversion. It's underperformed, but the change in the portfolio is low. So those are stocks which have not performed. And last 2 years, value itself has turned itself into growth. And those whole words of value and growth have become obsolete. So I think a great play in the mid-cap space for mean reversion is Kotak Emerging. Atul is the new fund manager, and I've gone through his track record of making decisions, and that seems fair. On the small cap category, I would say Invesco Small Cap. Invesco Small Cap is personally managed by Tahir Badshah, who's the CIO of Invesco. And if you look at its size, I think it has the size advantage. In a small cap fund, you would see that there is a lot of difficulty in moving the top 10 positions as soon as you move the 10,000 crore needle. So I would say Invesco Small Cap. These are the three funds, all trying to give you a flavor. So 50, 25, 25 to be more specific in terms of the weightage which you asked for.
50, 25, 25, large cap, mid and small, right?
Yes, sir.
Coming to you, Feroze, and a word of caution I'd like to request you to make on the kind of sectoral and thematic funds whose NFOs have sort of sprung up like, how should I say, green shoots across the Lal Street. Is this a trend which is indicative of probably an intermediate top in the market, or you think that the markets are now mature and independent enough to address this kind of a theme as well?
Shelji, you rightly pointed out there's so many NFOs coming up. So I personally think that firstly, if you go into a sectorial fund, you have to remember that the fund managers who are running diversified equity funds know that already. So if a Sandeep Tandon in his quant large cap wants to buy manufacturing, he's going to buy manufacturing and consumption. I was speaking to him yesterday. He says all the consumption names are with me, right? So he wanted to poise a little safer during the election period. So please don't think it is mutually exclusive information available to you, right? It's available to a diversified equity fund. This is the mistake which people did in 2008. The fund managers themselves had skewed their portfolios to before 2008 crisis. 50-55% of diversified equity portfolios were in infrastructure, and clients would buy 20-25% of more infrastructure. So 80% of one's equity portfolio was in infrastructure. And then if infrastructure actually goes down 80%, you can't cry on spilled milk that how can I lose so much money? So sectoral funds, only if those sectors are underexposed in diversified equity funds would you want to add and get that extra exposure. So those are to calibrate extra or reduce exposure to specific sectors, and they're not independent decisions, sectoral funds. Second point, which LG said, see, mutual funds have their job to complete their bouquet of products. It's not your job to participate in their completion of their bouquet. SEBI has given the restriction of how many schemes can be launched. If they've launched all the schemes in the other categories, the only thing they're left with is sectoral funds. So they're going to launch sectoral funds. You're not going to buy a rose from every bouquet a florist is going to have in his store. So you have to fill your portfolio. They have to fill their product portfolio. And there's no marriage there.
In the mutual fund space, I'm sure Feroze will agree on this one, that you'll see a plethora of funds coming in with options to have a 500 rupee SIP, even less. You know, a lot of funds even now have a 100 rupee SIP to attract this lowest strata of society. A very quick one from you, Feroze, on this one. Time is really short.
13-14, when the SIP number was 1,500 rupees a month, we had predicted about 5,000 in about 4-5 years. So I personally think I was looking at March 25,000 crores per month. I think that will be taken. I think by 2028-29, by this the third term or Modi 3.0 is over, I won't be surprised if it's 60,000 crores per month of SIP money in mutual funds from the 20-21,000, which it is currently, because the number of mutual fund investors are significantly lower than demat account holders itself in the country. So I think there's a huge penetration possibility, and that will happen over the next 5 years. So 50 to 60,000 crores of SIP per month, which is more than $5-7 billion a month, is going to come from the lower strata of India.